All right, everybody. Hello from Bloomberg World Headquarters here in New York. I'm Carol Massar, in today for Rhonda Schaffler. You are watching Bloomberg's Open Exchange. Our first guest managed to steer clear of the tech bubble and its subsequent burst. He also avoided financials last year. Alan Lancz is editor and publisher of the Lancz Letter and director of research at Lancz Global. He joins us in studio on this Friday. Good to have you with us.
Thanks, Carol.
I want to ask you, Alan, you did avoid a lot of bubbles in the past, including the financials. How come? What kind of kept you away?
Well, there's a number of things. I think when you look at transparency, accountability, and greed, and those are all mixed together, it's usually an area or a time to be very careful.
But what specifically? What tipped you off that you were seeing kind of greed if you were within the financial community?
Well, the financials, what we saw is they kept on increasing their earnings, but it was how they were increasing their earnings. They were doing it by excess leverage. They're increasing their dividends. Unfortunately, that made a lot of conservative investors get in, thinking it was almost like a utility or a safe investment, when actually they were taking more and more risk, and that's how bubbles are formed. As more and more people make money in those areas, more money flows to those areas, and those financial companies don't want to at least stop as far as the push of new money, just like they did with tech stocks, with new, tech mutual funds, et cetera, et cetera.
All right, certainly a warning sign to you.
Exactly.
We're going to take a break and come back and talk more maybe about how maybe your strategy is changing at this point. Sure. All right, everybody, we are going to take a break. After this break, a look at your business travelers forecast. Plus, we're heading to Davos, Switzerland, where Adobe's CEO will be our guest. We're back in 2. Welcome back, everyone. We're back with Alan Lancz, editor and publisher of the Lancz Letter. And Alan, just before the break, wondering if you've changed your strategy at all at this point, and have you?
Actually, we have, Carol. What we're doing now is a lot of the things we warned about a year or 18 months ago are starting to look appealing just from a valuation standpoint. So a year ago, we were warning about Google and Apple at 200 or 700 and 200 respectively, or even the emerging markets, which had an incredible run for 5-6 years. Some select areas in the emerging markets look attractive. I think a Google, when it gets down under 300, or an Apple in the 80 to 90 or lesser area. Mm-hmm. Whenever you have that panic selling, I think it's a good time to start nibbling on quality.
Alan, I totally get that in terms of the valuation plays, but if the fundamentals don't support stocks doing better, the environment doing better, the economy doing better, you still got to be very careful in terms of these plays.
Exactly. I think that's where you have to go with the quality. In other words, you have winners and losers, and the market is starting to differentiate this. So, Apple had great earnings last week. Google had...
Surprisingly so in this environment.
Exactly. And they're taking advantage of their weaker competitors, and that's what you want. If they can survive now in a bad economic environment, they'll just be that much stronger when we get out of this.
All right. When you bring up Apple, you got to talk about the concerns that have been out there about Steve Jobs' health. How concerned are you about that?
Well, I'm concerned to a point where when that's brought up, we use it as a buying opportunity, because I think...
Even with the company so closely identified...
Exactly.
Or with the CEO, I should say, so closely identified with the company.
Because it's discounted, and that's what I mean by buying it.
Is it really, in your view?
When you buy it on weakness, yeah. I think, $200, 12 months ago, and if you can get it, 80 or less. And I'm not saying that that's the bottom. If his health, deteriorates, it'd be a situation where you might be able to buy it at 60. With that cash, I feel very comfortable that the people there can do a good job, and that Apple will live on.
What about, though, the thought that, consumers kind of, not a lot of maybe discretionary spending at this point, that maybe I don't need an iPod or I don't need a Mac. I mean, different than the business environment that might play into the BlackBerries and so on and so forth, where they really need it, consumers might think twice.
Oh, exactly. I think, that's why you're buying it so cheap, and again, this is just one, with the cyclical or higher risk plays, Carol, what we'd be doing is only buying it into panic selling like what we had last week. Now that these stocks have moved up, I wouldn't be chasing them. I would go with more defensive names, high quality companies, as far as when the market moves up. You're only buying these type of cyclical companies or higher risk companies, growth oriented companies, into these panic selling opportunities.
Okay, and expect some volatility, no doubt about that.
Definitely.
All right, got to take another break. Alan, thank you. And I know you're going to stick around for the next half hour. We're talking with Alan Lancz, editor and publisher of the Lancz Letter. We do want to remind you that you can read more about all of today's stories online at Bloomberg.com. And when we come back, we're heading to the Swiss Alps, where Adobe's chief will be our guest. We're back in 2. That was Morgan Stanley Asia Chairman Stephen Roach speaking earlier this morning from Davos about when we can expect an economic recovery. Do want to get back to our guest. We were talking with Lancz of the Lancz letter. Alan, in terms of the economy and the economic outlook, do you think everyone is just way too upbeat at this point? I mean, many expecting a recovery in the second half.
Oh, yeah, I think consensus is a recovery in the second half. And again, consensus will be wrong. This is a global systemic financial crisis. If it took us 2.5 years to get out of the telecom bubble at the start of this decade, I think it's going to be a long, drawn-out process.
I mean, this is much worse.
Much worse. I think we're making the right steps finally. And I think what's protracted this problem is our procrastination and the problems of ignoring, the subprime and the ripple effects and those type of things that many people besides ourselves warned about.
And in terms of strategy, you think this, though, is an opportunity for some investors to pick up some of those really badly beaten down stocks that really have a good outlook. You mentioned Apple earlier. Another one that you like is Suncor Energy, down about 60% in the past year. Why do you like it? Why does this name kind of stand out for you?
Just incredible reserves as far as with the oil sands in Canada. And right now with energy down so much and Goldman talking about $20 a barrel oil, where 6 months ago they were talking about $200 a barrel oil.
Crazy, right?
Yeah, I think it's a great opportunity, and eventually when the economy does recover, oil prices will go up, and they have a great reserve that doesn't have the geopolitical risk that Russia has in other areas.
Two things come to mind when I think about an energy name. Well, first of all, let's talk about some news event that came out on it yesterday. Moody's lowering its ratings on the company yesterday. It affects about $4.1 billion worth of debt. Not exactly what you want to see happen when you're either owning that stock or looking to buy it. So that doesn't worry you?
No, I mean, that's, again, just like with Apple, in the 79, 80 area, that's the opportunity. We don't know where the bottom is. We're buying it in the teens. If it goes down lower, I think, it's a good opportunity long term.
What about the emphasis on alternative energy? Obviously, the Obama administration, that's certainly been a platform that they were pushing before the elections and expected to continue after. How would that maybe affect something like Suncor Energy?
Well, I think, that's why the stock's down, 60% right, with worries on that type of thing. And
you're not worried, though, about it?
No, I think, alternative energy is down the road. It's not going to be a factor for 5-10 years, and in the interim, we're still going to need oil. And whenever you get this consensus opinion where everybody's bailing out of something and, buying treasuries, the time to buy treasuries was a year ago. The time to buy energy is now, not a year ago.
You mentioned treasuries. I mean, typically a safe haven. Lots of everybody kind of focusing on treasuries. Lots of new issue, if you will, as the government looks to kind of finance all of their bailouts that they're doing. Treasuries also a way to go at this point?
No, I think just the opposite. A lot of people flight to quality. They're going into treasuries. Yields are historic lows. I think more people will lose money in long-term treasury bonds over the next 10 years than any time in history.
You think equity is a better play at this point, even though that there'll be some more volatility, no doubt about that?
Yeah, I mean, again, it's the early stages. It's a bottoming process, but I think that we're in a situation where now is the time to gradually buy.
Okay, we talked earlier about how you avoided the whole financial mess. You stayed out of financials. Good call. What about financials are you buying now?
In November, we put Goldman Sachs and J.P. Morgan at 52 and around 21 on our buy list on Lancz Global. And basically, those are the two areas that we've gotten into in the financial area. Mm-hmm. Last week, J.P. Morgan went into the teens. We bought more. I think what you're going to see in this market, Carol, are 20 to 30% moves in both directions, as opposed to last year where it was primarily down. So when you get those type of moves, take what the market can give you, take some profits, but at least
take some profits.
I think so. When if you get a 30% move in a market like this, take the profits and stick with high quality. You have to be selective. Don't go across the board in an ETF. And I think the indices.
Yeah, but even being selective, it seems like last year you still got burned.
Last year, this year I'm talking.
It's really different, you think, this year?
Yeah, there's starting to be differentiation between the winners and the losers. We're seeing the light at the end of the tunnel with the bottoming process, with the financial crisis. So, I think gradually buying the quality on the weakness into the panic selling is smart.
One other name I want to throw out to you is Heinz. That's down about 10% this year. It's doing much better than the S&P, which is off about 40% in the past 12 months. Barron's recently had a story saying they could be an acquisition target. Is that part of the attraction for you?
Yes, a lot of, even Suncor, I think if it stayed at this level, I think eventually, when the credit markets unfreeze, that, it would be taken over if it continued to drop. That we look at those things, the risk levels, when we get into something. Heinz, same thing. We put it on our buy list last week at 34 something a share. 4.8% dividend, trading at 10 to 15% discount to its peers. Very defensive issue. The 20 years after 74, 75, the areas that really beat the market were defensive.
All right, good to know. Ellen, thank you. Ellen Lancz, we're back on Open Exchange, 2 minutes time.